Alright, so before we start a discussion about just economics in general, I've noticed that a lot of other discussions that are out there have some type of legalese statement, right? And they say, nothing forward-looking is constituting financial advice. This is for entertainment purposes only. The whole point here is to go through brainstorming, not to give people a, you should do this.
So you want to give a disclaimer.
Right.
Okay.
So we need some, and maybe what I just said forms a disclaimer.
For one.
Right.
This is just our opinion.
Right. This is just an opinion. This is a brainstorming.
Yeah.
This is entertainment value, not financial advice. Full disclosure, I do work currently for a company that does deal with that type of shit. But I don't work in that capacity.
Yeah, and this is all just from us falling down our own rabbit holes, essentially, and linking together things that maybe others haven't linked with critical thinking.
Right.
And then just also adding our gut and intuition into the mix to then form thoughts that now we're going to vomit out,
And neither one of us are
experts in any of these fields.
Exactly, right?
Yeah, whatsoever. I'm kind of ignorant to the whole stock market money stuff, but I am very, intuition, gut-based. Like, I have a feeling. I have no facts or knowledge to really... Well, I do have some, you know what I mean? But it's more feeling-based, and you have a lot of...
But no formal training, right?
No formal training.
I've literally been in this job for less than a year. It is a...
I don't think the job... You had all this knowledge before the job came around, too. It's just there's been a lot of confirmation to the things that you were already thinking.
But it's all personal development, right? None of this is school-taught. None of this is work-trained. None of this is your...
Literally, we're growth and information junkies.
Exactly, right?
In our free time.
So that's kind of the framework that I wanted to talk about first of like, hey, these are two people that are looking at things from, let's say, a multi-factor, full picture. Let's tie some things together and say, hey, nothing in the universe is driven by one factor and one factor only. Right. One single variable never decides the equation in the real world. Even if that's what you're taught in freaking math classes, it's one or two variables. No. That's not the real world. It's usually
a very...
Right. So what we want to do is start a discussion about the web that we see as quote-unquote normies. And then, and maybe that's not whatever. Some people may be offended, but, if you're an offended type...
You meaning people that aren't in that industry.
Right, we're not in that industry.
We're just literally some people that work some jobs and,
Correct.
The cat just stole your socks. Okay. Weird. Do you think, dude? All right. But, yeah, literally just from people that, You're just trying to say we're just regular old folk that read a bunch of articles and like to absorb information in this realm and think about it.
Which puts us on an eccentric side of the spectrum, so to speak, but doesn't necessarily mean that we're professionally trained or this is all that we do. This is a little... Or
that we have insider information of somehow.
Right.
Yeah. Okay,
so that's all of the clarifying portion of it to say, before we start the discussion...
4-minute disclaimer.
Let's get a 4-minute disclaimer going of, we're just normal people talking about shit from the outside. Okay? And what we want to talk about is, bubbles that we're seeing in the economy. And sorry for anybody that's hearing the recording. The phone's down on the table, and I tapped it a few times. It might get loud. I'll keep that in mind.
And if it goes, quiet to loud, he's kind of spinning around in his chair to deal with the ADD squirrel,
Yeah.
So.
Yeah, about that. So, bubbles in the economy, and...
Yeah,
so...
A crash is freaking coming. That's what I've been saying for years, and like I said, that's coming from my little gut intuition of, something's gonna happen. I can't, cite any sources. I can't cite any, the stock is doing this and the numbers are here and blah, 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 but I'm just like, something's coming. Right. I just wanted to say that.
I hear what you're saying.
And so then my brain, which is Edwin, the intellectual, analytical person of the two.
So I work with economists. And about a week or 2 weeks ago, maybe, I came from work and told you I had nailed down when I thought a date was, right? Of when a soft start to a recession would happen, right? This is when we start nosing over, and I made it a window. And when I said it was like 60 to 75 days, and that was, what, at least 2 weeks ago. So we're definitely in the 1 month or less window, and I'm looking at other stuff,
But, just like Gary Vee and Tony Robbins were saying, like, it's the fortune-telling business. We really don't know, because there are people, in my opinion, behind the strings manipulating it in ways that can extend it or make it come quicker. You know what I mean? Like, we don't... But go ahead.
Right, and we're starting to see more and more news outlets talking about the possibility of this coming recession-wise. It's like media is priming us for it, and all the red flags are starting to come up. And there are people who they have a business model that says that the crash is going to happen. Okay, that's...
like they make a business off of saying it.
Absolutely. These are
so if a crash isn't coming around the corner, they're also kind of just like...
Yeah. These are your fearmonger gold sellers.
Right.
The guys that say, take your money, throw it into gold, make sure that you stuff it in your mattress. Don't participate in the market because it's all going to catch on fire. I don't know about that, right? Mm-hmm. So... I've had an eye on them as, let's say, the canary in the coal mine, and when they have enough real facts that actually back up their fear-mongering, then I go, hey, maybe this is real. And then I dig a little deeper.
Something to look into.
Right. And then, I see some more articles of what is overvalued, okay? So we wrote up a whiteboard with a few areas, one of which is not on there, which is venture capitalism, which is the whole Silicon Valley tech bubble portion to where you have these companies that are extremely overvalued to the point that, so in one of these lists, only looks at these companies that are $1 billion plus. There's 260 of these companies, and their cumulative valuation in the economy is over $840 billion, which is, let's say we take and spread it out. I would say that the total value is like $1 trillion. And this is people like Uber, SpaceX, WeWork.
All right, so where are you going with this?
So what I'm saying is these are venture capitalist companies where their valuation grossly exceeds what their return on investment is for a shareholder. These are... I hit the I believe button and I throw money at these guys, and some of these companies literally have not made any money, and some of which in a decade. Like, people have been just throwing money at a company saying, I believe in this company.
But their profits aren't showing anything? Is that what you're saying?
They don't have profit. Meaning they're burning millions of dollars that people are handing them, and nobody's getting money back. And the only reason why the stock value continues to go up is because people keep shoveling money towards it.
And so you think that is, like, when we're talking about the factors, the red flags, that is one of several red flags we're going to discuss today.
Absolutely. And this is like the tip of the spear when I start talking about stocks in general. And what other people are saying about overvaluation of stocks. And
like, this is where that's coming from.
It's part of it, it's, let's say, the worst of the worst, so to speak, right? So people buy index funds or mutual funds or whatever, And the majority of America, when dealing with their 401k, myself included, doesn't have the option to say, I'm going to pick out these individual guys because they have a good track record. They have a lot of assets on hand compared to their valuation. They have this. So instead, you get this shotgun blast, I just believe in the market, or, hey, I believe in a foreign market, or I believe in this particular index fund, which is cherry-picked by somebody else, but doesn't necessarily mean it has a good process that really accurately looks at the leveraging ratios. Like, there's a whole bunch of numbers that they go through that's like, essentially for a normal person, is what's your debt for your household, what's your what's your inflow of cash, what's your outflow of cash, and then what's your growth potential, right? So if you think about it that way, like, what I wanted to discuss with you is how do we frame this in a way that you understand without using any of the industry terms.
All right, I'm saying you've already lost me with this.
Okay. All right. So, if you go to any of these stock websites and you look at this shit, they have all these crazy terms that nobody gets, right?
I know. That's why when I was picking out my 401k, you're just like, yeah, whichever one y'all suggest.
Well, but that's kind of because I can't go into my 401k fund that's through work and be able to cherry pick stuff, right? Now that I've taken vested amounts out of my 401k and put it into my bank, I can go in there and pick individual stocks. It's still a 401k.
But, okay, I hear that.
But most people don't do that shit.
But it's like, where were you going with the whole, like...
Okay.
Looking at the individual household of...
Okay, so here's the deal.
Like, where does that come into the stock conversation at all?
Okay. So what I'm trying to do is draw some parallels between household budget that people might understand and a company as a budget or valuation and stock, right? And some of these companies, their value that people are paying in stock are like 30 times, let's say, net worth, right? So we look at the net worth of our household and we say it is X dollars, right? That, in terms of a company, would be total assets on hand. Okay?
Can I draw a thing and see if this is where you're going?
Yeah.
So basically, a house down the street, they're like the from the outside, the neighborhood millionaires. You got this crazy house every single week. You know, they got the freaking McLaren. They've got the blah blah blah. Every fancy, expensive thing.
Yep.
Word, put it into that sentence.
Right.
And however, and so then, like, there's, you know, people, for some reason, like, it doesn't really pertain to this because people don't just hand people money like that, but, like, there's people being like, wow, you're these rich people, here's some more money, here's some more money. Yet these people behind the scenes are actually in astronomical amounts of debt. This family that we're talking about is in astronomical amounts of debt. But instead of taking that money that these people are investing in them and paying off their debt, they're just burning it more. They're buying more McLarens. They're buying a bigger house.
Yeah, which is a common household thing, right? You get a promotion at work.
The value, they actually have no value. They're actually in insane debt.
Yep.
Yet from the outside, it looks like...
Yeah.
Like, from perspective of a person not knowing the books.
Yep.
They look like, it's like, wow, they are really doing some stuff.
Well, and that's the difference between a star that has a cocaine habit, you know, in Hollywood, and someone who invests their money like Mark Wahlberg and has, like, 6 different business ventures, right? Mm-hmm. He actually has some value behind the scenes. The rapper that's doing, you know, 5 pounds a blow and has a $30,000 a month cocaine habit.
And like a watch collection that could, like, buy the Sistine Chapel.
Right.
Like.
So, and as they get more fame and more contracts, or whatever it is, their income starts gaining, maybe they continue to gain momentum in these negative cash flow habits, okay?
And so that's where you're drawing that comparison of, like, these companies that we see going up in the stock market. It's like a false valuation. It's a fake
There's some that are out there that are like that, right? That you're saying, you know, I'm giving loans
going up because people are throwing money at them, yet like it's their actual commodity and their actual profits aren't going anywhere on the books.
Right. So who do I want to loan money to if I'm holding my money? Do I want to loan money to the guy down the street that lives in a double wide that's 100% paid for, that has $100,000 sitting in the bank, and has an average job and continues to show steady savings and growth and fiscal responsibility? Or do I want to, you know, hand loans to the next 2-bit rapper who's blowing, you know, you look at the Johnny Depp story and he's got a $30,000 a month wine habit, right?
Yeah, and like 50 Cent going bankrupt after fucking, yeah.
Right. Okay, so who do you want to loan money to? The guy that's actually going to pay you back?
As being really smart, living within his means.
Or the guy that can go bust in 30 seconds, okay?
Right.
And that's the argument with a lot of this shit of, like, why, you know, working in the automotive side, there's a lot of people that are pissed off that work for, like, Ford or GM or any of these automotive companies. Are like, we show a 30% growth on the money that comes in sustainably on a quarterly basis, and Elon Musk is over there just burning $1 billion a quarter on, you know, electric cars and hasn't made a damn dollar back. He's literally been 10 years of just sucking in money, and that is kind of the way I'm trying to show all this. Who's going to go bankrupt? Who's screwing their shit up because they're not responsible, and how do you understand it at a normal household level, right?
Okay, so the first, like, let's nail that down. The first red flag is in the stock market as it is, there's money, there's a bubble being created in the stock market because there's numbers saying that. So there's trying to say the stocks are going up, but the actual value of the company doesn't really reflect that in the books.
Absolutely.
That's where that stock market bubble.
Right, and the growth of these stocks is more due to insane cash flows of people from
investment funds, putting money towards it, or what?
Specifically, let's talk about the whole tax haven portion of onshoring of cash, and then let's also talk about people in foreign markets shoveling their money to the U.S., right? Those are the two huge influxes, and let's say it's on the order of trillions of dollars just to...
Okay, we'll keep that real simple. Let's not go way too deep down every single rabbit hole in the world.
So the value of the stocks keeps getting pumped up. It's not like they have more assets on hand. It's not like they have some new process. It's not like they've lowered their bottom line. It's literally because people keep throwing money at it that the value of the stock keeps going up. Okay.
And you're saying the money's being thrown from a number of different sources.
Yep.
One being overseas, one being, like, sort of list that out.
Yeah, so it's one, like, just overseas money in general, whether you're a foreign company, you're a person that is outside of the United States that wants to bring money over here. This comes a lot from China. These guys that want to get their money out of a volatile currency like the yuan, and they try to get it into U.S. dollars because they feel like that's the right thing to do. There's even these weird scenarios where if you pay somebody like $100,000, you can become a U.S. citizen, right? So there's all this like weird shit that goes on with this, and there's incentives for people in foreign markets to bring their money into U.S. dollars. So if you combine that, so that's one type of bubble. The other bubble is, hey, we're doing this program to keep people from hiding their profits as a company in offshore funds, okay? And so that's the whole Donald Trump tax thing. And those two things together bring in this big flow of cash. And this
what Donald Trump tax thing? You're losing me right there.
It's what I was talking about with the offshore corporate funds.
What? That they exist? That they're not being allowed to exist anymore?
So they exist. They've existed for a long time, and like Apple,
offshore funds. They're like, money's overseas.
Apple had like billions and billions of dollars overseas. Cayman Islands or wherever the hell they're keeping their money. And the idea was to shelter it from paying taxes.
Correct. So now what's happening?
So what happened, let's say, because that's past tense. Oh, yeah.
What had happened
was, right, let's break it down all the way to the lowest common denominator, is that he said, hey, you bring this shit over, we're going to just overlook the fact that you've been hiding your assets from me. We're going to knock you down to this low price of this number here. So they're like, oh, sweet, this is a bargain. Let me hop on the bargain right now. So that brought in waves of money, okay? Now.
He was basically saying, you have to bring your money back over here, but I won't prosecute you for what you've been doing.
Mm-hmm. So here's yet another fact.
And here's a low here's a low percentage.
Yep.
To be you're going to be taxed on it now, but like it's not going to be as bad as it would have been.
Oh, yeah.
Go ahead and do this now.
Okay. So
I hear you.
You see these are kind of two different factors.
Correct.
Now you have another one, which is the looming tariffs portion of all of this shit, right?
Yeah, that shit confuses me.
The whole idea that you want to protect a local business, local production. From an environmental perspective, it's great. From a logistics perspective, it's great. The idea is to make sure that your local jobs are protected, the local businesses are protected.
Okay, so because China, overseas places they don't have these laws of, as strict of laws of
minimum wage, unions.
Exactly, work conditions, yada, yada, yada. And so they're able to create the product and sell the product for insane cheap
pennies on the dollar.
But then over here, so we've got local companies that are in the same industry, let's say.
Yep.
Yet they have all these rules and regulations that then drive their price up, but they'll never be able to compete with this overseas company because they won't have the profits there, because their overhead's so much higher because the rules and regulations. So then Trump came in and did something about that, saying, okay, well, if it's coming from overseas, we're adding this tax on there that sort of levels the playing field.
It tries to.
That was the intention, though.
Yeah,
I'm hearing? Okay.
That's kind of let's say what had happened.
Right. Okay.
That's the story behind it. How those funds get used and everything else. That's a whole rabbit hole.
Let's not do that.
Let's not do that with this, but the idea is trying to figure out how to have a better trading environment. So all of the threats of tariffs led to people saying, okay, if you're telling me when you're going to enact these tariffs, I'm going to go ahead and I'm going to buy my shit on discount now before that hits. I'm going to buy my commodity and put it in a warehouse and wait for you to put a 25% tariff on aluminum or steel or whatever it is. And sorry, we're a little distracted by a kitten running around with my socks.
He's obsessed with your sock right now.
Yeah, I know. It's fine. So that's what happened there. And now, and once again, I'm looking at, a little bit more towards the fear side, is some people talking about the slowdown of international trade, whether it's shipping, container movement, air movement, and the root data had come from a pretty good source. The article was on Zero Hedge, so they are, let's say kind of off of the beaten path, to be nice about it.
I think going down that way is a little deep into just this one red flag. You know what I mean? We wanted to sort of gloss over all these different.
All I'm saying, and trying to, I'm going to cut it here, okay, right? Which is you had all of these shipments spike, and now they're coming down to a much slower rate. Okay,
so because of this tariff situation, but it was this isn't going to be enacted until at this point.
Yep.
Everybody's there was this rush.
Yep.
happening, and now it's chilling out.
Well, it's not just that. It's like people are sitting on excess. That makes it kind of like another bubble.
Yeah.
Okay? And that's what I'm trying to get to here, is like you have excess here, excess there. You have a bubble here, you have a bubble there. You have these like conditions to where shit is overvalued, overhoarded, overproduced, whatever it is. You're going to have some form of shift in the economy because of all this. Right?
Mm-hmm.
And there's a difference between a correction in the market and a recession. Correction is a 10% thing. A recession is 20%. Right?
So let's... Go ahead. You can finish your thought.
So we're going to go on to the next... Like, the whole idea here is we have multiple bubbles, and we're looking at each one.
Right. But real quick, so we touched on stocks. I don't want to spend a whole half of this talking about the stock market bubble, but I do want to sort of touch on the fact of... sort of where a lot of my feelings of like a crash is freaking coming, even though I don't have all of the data to cite, but we do see basically a carbon copy of the atmosphere prior to the 2008 crash happening. However, because it's a shit pile, like the 2008 crash created a shit pile. That shit pile was never fixed. It was literally just like, let's just put, it's like Peter Griffin like pulls the table on top of it, like, don't look here. That was the fix. Like, just put it in its own corner. Well, now there's a shit pile building on top of the other shit pile. So the same scenarios are happening as the 2008 crash, but it's louder. And, you had made a good point that I wanted you to touch on regarding, like, and I mean, there was another crash that was, in 2000? So, where are you seeing the similarities with when it came with the .com crash? You see what I'm wanting me to sort of touch on?
Yeah. So, and that's what's happening in Silicon Valley with some of these tech companies, right? I have this new thing that uses one of, let's say 10 or a dozen buzzwords, and I'm about mobility and artificial intelligence and 3D printing and this and that.
Prestige worldwide.
Exactly. That's the common man understanding. When Step Brothers throw their business pitch out there, everybody looks at them like they have a freaking metaphorical dildo suction cup to their forehead based off of their quote-unquote business plan, right? And they're saying they're becoming unicorns, right? But that unicorn is not a horse. It's a person with a suction cup dildo on their forehead. Yeah, you're a unicorn, all right, buddy. Good job.
So these people that, like, sort of like what happened at the .com crash, there's value going to companies where they really aren't. They're just using the buzzwords, just like sort of when, what's it called, in blockchain. Yep. Like, where everybody's just like, blockchain this, blockchain sports beverage. You know what I mean? They just add this buzzword to their product.
Like
yet,
Arizona.
Like, it has nothing, the value of that actual item, of that actual thing, blockchain, it's not, they're not combined here.
Just like Arizona Beverage Company,
but people, ignorant people are like jumping right on that board, being like, that buzzword's involved in this thing, here's my money. Well, but then once everything calms down, you're like, there's no value there.
Exactly. It's all the hype in the marketplace.
Which creates another bubble.
Right. So, Arizona Tea and Beverage Company, whatever the hell they're labeling themselves at, made themselves the Arizona Blockchain Company instead of Arizona Brewing Company.
Right.
And they sell freaking fruit punch in a can that you buy at your convenience store. It's not like they came up with some new formula of process or, got cheaper aluminum cans or revolutionized their distribution system. They literally stuck blockchain on their name and had a 25% increase in stock price overnight.
Yeah. Okay. Well, just like, and now it's moved to a different buzzword, but the buzzword of natural. There's no, like, laws in the FDA, blah, 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 or, whatever is over our food consumption, stating natural has to mean this, 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 and this, and this. And but everybody's now putting natural on their packaging.
Yep.
Even though you look at the ingredients, not a daggum thing in there is natural. Well, maybe a couple things. Water.
Well, it's natural flavors that come from a beaver's anal gland, right? So, after it's been synthetically modified.
Right, but
not
it's
to get
natural. Yeah, let's not go down that hole.
Yeah, let's not go down the aluminum haberdashery rabbit holes on any of this stuff.
But let's talk about the other bubbles. So we talked about the stocks bubble and sort of... So you want to keep going on .com?
Yeah. And what I want to stop and pause and really underline here, okay, is we have indicators of old habits, okay? The venture capitalism in Silicon Valley right now reminds me of .com, a complete parallel, okay? The other items on the list so that people know whether or not, it's been half an hour, do they want to keep tuning in or not? Housing. Housing's an issue. You kind of touched on that. Car loans. Car loans is a new bubble that people aren't talking about. And then let's talk about government debt, right?
Right. So okay, let's move on to the next bubble. Yeah. Let's keep it pretty, let's put car loans and Japan government debt later. Let's talk about housing, because that affects, the majority of the people. I know a lot of people in our generation and even younger are looking for houses. If not, they just jumped into it. So let's... Yeah.
Okay.
That bubble. And talking about 2008, you know what I mean?
So, first of all, if you want to take notes while you're listening, go watch The Big Short. Skip the whole damn thing. Read some Cliff Notes thing and look at the end credits when they say, hey, the root cause of the housing bubble started all over again in 2015. Exactly the behavior was changed in name. It's the same process, and it's happening again. And if you look at valuations of homes in most metro areas right now, they've gone beyond the peak before the crash. Okay?
Right, so, which is, and the common trend of all of this is things are valued at more than what they're actually freaking worth.
They're overpriced.
They're overpriced. I mean, we can say we were house searching. We've been house searching for the last 2.5, 3 years, something like that.
Absolutely, bad time.
And we're seeing mother freaking trailers. And let's not even say they were newly built. Trailers basically falling apart at the seams, being valued at $250,000.
Right, and
you tell me where that value is.
And it wasn't on sufficient land to make it worth that either.
Or even in an area that it should be. We're looking in Bumfrick.
Yeah, BFE.
In BFE, we're not looking right next to Raleigh or, right outside of the Charlotte area. We're literally looking at BFE in areas where the economy is already daggum crashed. Companies are moving the hell out of there.
Right. It's not like it's a prime area where business developers going to come in and I can turn that single piece of property into 100 cookie cutter houses and triple my money.
Right. So as you tell me where you've gotten this value from. And the other thing, I'm probably going to go down a little... Help us rein this in, and you don't go too far. But we see an issue when it comes to appraisals. I think that's one issue with it, because they're going in and just saying, okay, there's such and such square feet.
Yep.
Here in this area, this square feet equals this. So you've got to place a house that someone has actually just updated. There's granite countertops, there's et cetera, et cetera, et cetera. And it's because its square foot is exactly like this other house down the street. They're being valued at the same, but this other house down the street, I need to go in and gut it completely the hell out.
So you mean that the size of my Lamborghini, if the shadow of my Lamborghini is the same square footage as my Honda Accord, my Honda Accord is now valued at a Lamborghini price.
Exactly, even though the Honda doesn't run.
Exactly. but that's the reality of some of these houses.
Put a new engine, put a new trans, put a new everything.
But we looked at this.
But the shadows are the same.
Right.
Exactly, and I think that's one big issue is...
Well, that's because part of it is...
Like I said, rabbit hole.
We have no qualitative valuation system for housing, right? If anybody listens to this and is smart on... databasing more than I am, I'd love to start house facts. I'd like to use some type of database system that says...
Just basically, if you've got skill in X, explain what you need skill in.
Just
website creation, database.
Just database management.
Database management, maybe data architect.
Yeah, something like that.
Like, y'all comment below, send us an email, we'll put it down below. Like, let's freaking work together on something because
there's a market need.
But anyway,
good way to stop me there. But there's no qualitative system in place that looks at a multi-factor approach.
Yeah, and so these values are just going up, up. And a bubble can only expand to so big.
And then, the eventual pop happens.
The pop happens.
Okay. So, and that's like that piece of property that's down the street from us that somebody bought, 80 acres? That's down the street.
Yeah.
And they're listing it at $50,000 an acre. Holy shit, what are you smoking? Because that, and it's completely undeveloped. It's off of a dirt road, and you think you're getting $50,000 an acre? It's not happening. And that's why that property has sat there for over 2.5 years now, right?
Just while we've been here, but I think it's been on the market even before that.
Yeah, and it had already been on the market for it's literally sat there for 5 years. They're never going to get that value out of it. So then you start seeing quote-unquote value loss, which is really you overpaid through your nose for something that wasn't really good.
And everybody's trying to make a profit on something that you didn't buy on clearance.
Right. So you bought something at inflated cost. You threw a coat of paint on it. You might have done one or two things to make it a little more visually appealing. But in terms of commodities, structure, repairs, real long-term value qualities,
it's not there.
It's not there.
And then the other thing is, the market keeps inflating and jumping up, and jumping up because people are, in certain cases, getting desperate.
Yep. If
you have to move to this area for a job, and you have to buy a house, and these are the only houses that are on the market. I mean, like that house I showed you that was somewhere in California, outside of LA, something like that. It's insane. It was 900 square feet, and they're asking close to $1 million for it. That's because of, and they want to say supply and demand or whatever. But then, so that purchase, when someone's like, well, I'm desperate here, just take my money, whatever, that purchase then makes the rest of the market, because that's how appraisals work. They say people are buying this square footage or this whatever for this price.
Yep.
This has been purchased at this price. Now yours is worth this because someone else is paying this for it. That happens in a lot of different industries. That happens in the car part industry and in your performance vehicle situation. You know what I mean?
Which is an indicator that a recession is coming, right?
Yeah.
Every time.
It can only go up so high before people say, I can't do it.
But it goes up the highest before it crashes. That's the way it rolls, right?
Yeah.
So you
want to move on to...
Well, yeah, let's move on to car loans, right?
The other thing that everybody has, basically.
Right. Well, most people, right?
Depending on
there's a certain social pressure, social status. This is what you're supposed to do. Don't go buy a $3,000 car in cash and get it, checked over and hold on to it for 5 or 10 years. Go buy something brand new off of the lot.
I mean, yeah, I was even talked into that.
Right,
yeah.
But the whole depreciating asset portion has started becoming an issue because let's just say what had happened was people start rolling over their depreciating losses into a new loan. So now you go buy another car, you trade in your depreciating car, maybe at the worst time, because you're dissatisfied with it, or because it was new and the system sucks.
It's already showing problems. That's another huge part of it.
Right. You buy a new car because you want something that doesn't show problems.
That's going to last. I'm not going to have to funnel money into fixing this or this or this because it's new. It's going to be great. And the thing is that's the other issue, is they're building cars based off of, these cannot last forever. That's a difference from back when to now.
Well, GM was the inventor of that, right?
What's it called?
Shit.
How you call it? It's planned obsolescence.
Yeah, designed obsolescence, right? And GM was the inventor of designed obsolescence, if you look back through the history.
If their car lasts them 10, 20 years and 200,000 miles, they're not going to be buying another one.
Right.
we need to put some parts in there that...
Well, that's why Toyota just really came in and ate freaking GM's lunch historically. They went to designed obsolescence or planned obsolescence, whatever it's called. And Toyota said, no, we're going to design our shit to go 200,000-300,000 miles. We're going to focus on quality. And then we'll have long-term followership from our people, and it won't matter what flavor of vehicle we make, we're going to have a solid reputation of reliability. In full disclosure, I used to work for GM, but when you work for GM and, your lease vehicle has been in the dealership for 28 fucking days, but they're not going to do anything about it, and you can reach out internally to the dudes who are in charge of the parts you're having problems with, and they're like, hey, bro, not my fucking problem. It's not on my checklist. You got a problem with what your attitude, your culture, right? And they bitch about their external value, and there's some really good people employed there. Don't get me wrong. And there's some good things in terms of future vision, but the implementation for some of this stuff, let's call it value engineering, gets to be really freaking shady. And the reason that cars drop in value so damn fast,
like our freaking Cruise,
is because of that. You upcharge the shit out of people.
You flood the market.
And it's gonna fucking break, right? So then, your thing that barely elapsed out of its mandatory minimum warranty gets traded in because you don't want to deal with a used car and go to a repair shop and shady, guys fixing it.
Yeah.
Or you like the social status portion, or whatever. Let's not even talk about vehicles coming off a lease, because that's a whole different indicator. But the idea is the leverage ratio of a car is getting worse and worse. And then additionally on top of that, the length to pay it off is getting longer.
Yeah.
Why the fuck do you need a 96-month loan on what you drive around? Like, are you actually going to keep that vehicle, past 96 months to go past there? I honestly don't see the point in anything beyond, 3 to 5 years, right? Because a lot of people are getting rid of their car at 3 to 5 years.
A lot of cars can't last. I mean, it's...
Yeah.
Or whether it's mechanical or... in 3 to 5 years, there's a lot of chances of an idiot running into you and you totaling your car, or you hitting a freaking deer, or, fill in blank with whatever catastrophe that, the longer of time, it's just like you have to, these people that are buying their iPhones, and they're like, oh yeah, you can get this $600 phone now, and all you have to pay is just add X amount to your month.
Yep. That
phone is going to shatter, break, drop in water, and no longer be alive before you are done paying it off.
Yeah, because it's on the durable side of commodities, but it does have a propensity to, come into issues. It's not an iPhone. It's not an 18-month replacement.
Murphy's Law comes into place, and it's something that you drive. People are using it every single freaking day to get to work, to get to the store, to get to your kids' schools, yada yada yada, or something you use every day. The phone. You take it everywhere. You take it in the bathroom with you. You take it to the pool to take pictures. Take it to the beach. Take da-da-da-da-da-da. You know what I mean?
Yeah.
That's more options for it to break. If you've got a loan on it, you're upside down again.
Yeah, and so let's touch on that for a second, though, is that there's some perverse incentives with the insurance industry that come into that. If your shit's paid off versus, actually being underwater, there's not exact valuation for a replacement. So let's talk about the car that's sitting outside that, I bought it brand new at $33,000. It's still worth freaking $25,000, $26,000 because it's low mileage, right? Mm-hmm. If I wreck that, I'm probably not going to get my worth out of it between, shit I've done to it, which we already know that part, right? But the other side of it is, I don't think there's a replacement for it out there. It literally doesn't exist. Find a car that's a 2010, so it's been on the market for, let's say, close to 9 years out in service, and it's only got 33,000 miles on it, right?
Yeah.
So that valuation increase isn't going to happen. They're going to look and see,
they're going to try to get as close to that as possible, but there's not something that's close
I'm going to lose
it.
my ass.
Just like when we were trying to get our diesel mid-sized truck, like, appraised or whatever, and the guy's comparing it to gasoline.
Yep.
Because they don't have a comparison, and it's like, no, these are two totally different worlds.
Right, absolutely.
You go into diesel and you got to add $10,000, if not $20,000 to that value.
Right, and that's a function of perceived durability.
Exactly. We're going,
right.
Back on topic at hand.
But this does kind of mirror the house portion, right?
Mm-hmm.
It's about a more wholesale, qualitative valuation of actually all three topics so far. Is multi-factor valuation of goods, services, and entities.
Yeah.
And when I look at, who did the millennial study that I was showing you the other day? There's a consulting agency. They did a study of millennials, and here's the thing: is this new, let's say, new generation, whatever, not really the right thing in my eyes, but the new, let's say, adult consumer environment knows this. This is becoming cultural, and in this survey, globally, individuals are saying that we're pissed off at the people we work for because they go with single factor valuation and they're not looking at it on their day-to-day shit. Okay? And that's how the market is going to have to change after the crash.
Mm-hmm.
If they want,
like, have Groundhog Day and never again.
Exactly. All right. So
last point.
Yep. Let's get to the final valuation bubble. Okay. And this one is pretty straightforward. Japan is swimming in debt. Last year they spent more than a quarter of their tax revenue servicing their government debt. So just imagine that. That your 25% of your income at a household level goes straight to loans, right? Do you think you're thriving financially? Oh, and here's the kicker. There was a time period, right now they're currently the second largest holder of U.S. debt. You know, you get a lot of people screaming about how our debt is bad, right? And how our debt ratio is pretty shit. But the deal here is that the people who hold our loans and hold our debt are going underwater. That's a bad indicator for us, right? We're intrinsically tied to them. You know, they exceeded Japan's holding, or Japan exceeded China's holding of U.S. debt for a short period of time. You know, and
there's three that hold the most debt. We're talking China, Japan, and the U.S., right?
Right? No, we're talking about U.S. debt specifically.
I know, but I was just okay.
U.S. holding your own debt, that doesn't make sense.
No, I'm just saying being in debt. The three most indebted countries, would that be right? I thought you had
No,
okay.
Bad indicator.
Okay,
ignore all that. All right. The idea there is that, so first of all, Japan's actually up there in the economic rankings. They're not small fish. They're a large economy. I can say with decent certainty they're in the top 10, right? And then they're typically second or third in U.S. debt holdings, right?
Yeah.
So it's not like this is, let's go back to Greece, right? Greece, when they had their whole bankruptcy, there was a blip in the global economy because Greece's balance sheet was shit. Their government went into default, right? And they're still dealing with that, right?
Mm-hmm.
Some of the numbers, some of the indicators, the percentages of debt, all of this other shit for Japan is worse than Greece.
Mm.
Okay? So it's definitely one of those dumpsters that's waiting to catch on fire. Like, this is a potential dumpster fire where people are chain smoking all around it.
And so when that dumpster catches on fire, that proverbial dumpster catches on fire, so when Japan crashes, like it's going to.
Oh, yeah.
We don't know, but that then trickles to us, which could either make a crash that's already happened 10 times worse, or create the building blocks of our, or, you know, that then bursts all these bubbles.
Right, so that's
one
an idea of...
It's a theory of how...
Yeah, nah, I'm not going to go out on a limb and say which one of these bubbles is going to be the lead cause. That's about as bad as trying to pin down a date, okay?
Right.
An exact date. And I gave a range.
Nose.
Yeah. But what I am saying is, these are the cards that built your house of cards. Right? You pull... One of them gets blown on the wrong way, it all comes crashing down.
We don't know which lollipop under the couch caused all the ants to come, but, like...
There's multiple...
This is how you get ants.
Yeah, exactly. This is how you get ants. It's not a matter of if, it's a matter of when. And all of these have compounding effects economically. I personally think we're looking at, like... I don't know. It could be as bad as Great Depression shit, right? We start, look at what happened in the Great Depression. You know, history is a nice learning point, you know, and those who don't know history are doomed to repeat it, so to speak, to paraphrase. And these are multiple scenarios, and some of them are repeats of other scenarios, and they're all stacking up at once, which is just generally not good.
Yeah.
So, you know, we've been all doom and gloom, but the idea here is, you know, prepare for it.
Exactly.
Figure out how to hedge your bets.
You can be on two different ends of this. Yeah. You can let this crash serve you, or you can drown from it. And so...
We're on the side of trying to figure out how to make it serve us. We see it as imminent. We're not the only people.
Saving and having, you know, one of our plans is to save and have money to be able then...
Cash on hand
to when everything goes on clearance, because people are desperate to offload on, say, this overinflated house or, you know, what have you, where we intend... We would like to be able to drop cash on something on clearance. Other ways, you know, to prepare for this. I mean, we're not experts, but we are reaching out to experts. Or not reaching out, but, you know,
watching, right?
Watching. We're absorbing information. Tony Robbins has a new book that came out. That we're, you know, going to dive into. Gary Vee seems to be really smart. You know, just different investors, different people that when the 2008 crash happened, they flourished. I want to absorb as much as possible from these people and see where we can sort of learn some.
Well, I'm going to say it in
things to implement.
A catchphrase is keep calm and thrive on. Right? How do we thrive?
Don't react. Don't react out of fear. Don't panic.
How do you be prepared for it? And how do you find those right days to make the right maneuvers to compound your finances into growth while everybody else is, you know, freaking out, running around, hair on fire, and you're like, this is fine. I'm okay. I was prepared for this. You know, business as usual, or, hey, this is amazing, you know.
Right.
We're fine. If you think about it for another, like, type of scenario of, like, hey, you know, you checked the weather and you brought 100 ponchos to the stadium and a lot of people didn't check the weather and it's this freak downpour where you're just going to get soaked and you're the guy selling the ponchos, you're going to do just fine.
Yeah.
That's a great day for you. So perspective is really what we're looking to shift here. How do you turn this into something that benefits you?
Yep. Well, I think that was an interesting talk.
Yeah, and hopefully we figure out how to maybe make it a little shorter or a little less roundabout. But I think this is a good time length for anybody that actually wants to tune in the whole way.
Yeah. Right.
All right, so keep on keeping on.
Take care.